Good morning. Good morning. Good morning. I have seen a lot of creators talking about rising mortgage delinquencies lately, and some are throwing around huge numbers like you would never believe. And there are these big creators that like got swept up in this, it seems like, this event, and they threw this big graph around, and I'm going to show that in a little bit. And others are predicting a full-blown housing crash, and honestly, some of it could be true, but a lot of what I'm seeing out there is not just misleading, it's actually dangerous, because all these fear-based headlines, they do not help people. Real information is actually what helps people. Real, honest information is what is going to help you. So, not leaning into and not believing all of these fear based, the market's crashing. 6.1 million people are behind in their mortgage. That was the post. 6.1 million people were behind and seriously doing delinquent in their mortgages. And I know personally what it feels like to be terrified of not being able to potentially pay your mortgage, because I've been there. I've been that terrified, right? And that's what I kind of wanted to start today's live stream with, right? And I don't share this publicly all the time, but I was behind, right? There was a point in my life where we were behind on our mortgage. And I will tell you this, it sucks to feel that vulnerable, especially when you're in a place in your life where you're doing well, and then a series of events come up, which you can never foresee. And those series of events, it took years to get to a point where I was in a stage in my life where it's like, wow, everything that just happened for these past 3, 4 years, 5 years is catching up to me now. And now I'm in a position where my business is suffering. The market is what the market is, right? We can't control the markets, and I'm in real estate, right? And I'm a realtor, I'm a real estate broker. So I live this every single day. I've been doing this since 2016. And I found myself in a position where it's like, oh my gosh, we're going to have to modify the loan. We're going to have to call our lender and say we can't pay. We're going to have to ask for it to be deferred, or what do I do? Right. It was panic. I will tell you, it's panic. And I wish that someone would have said back then that, you're not broken. You're just in a hard season, and there are ways out of it. There are ways to get out of it, right? Because my goal with this channel, I'm not here to scare you. I'm here to give you the full picture, the real picture about what's happening with mortgage delinquencies right now, and who's actually at risk, and exactly what to do if you're feeling that pit in your stomach that I felt, because it sucks. I've been there, I've been through it, I've gotten through it, and I want to show you now how you can too if you are feeling it as well. So that's why for this live stream, we're going to walk through the latest data. I'm going to call out, what's real. I'm going to show you that post, that graph that was showed, which is just completely outright. Not that it was wrong, but it was very, very, very misleading. And I'm going to explain the actual steps towards the end that you can take if you are behind, or if you're worried you might be soon. If you're behind or worried you might be soon on paying your mortgage, right? And we're going to do some real talk, because I know I'm not the only one that's been through this. I know that. I know that there's a lot of people who go through time very stressful and unknown times of their money, right? Nobody likes talking about money. Nobody likes talking about it. And nobody likes asking for help if they are going through these issues, right? Because it's a pride thing. You don't want to show people that you need help, and I want to help change that narrative because if it wasn't for asking for help, you don't get help. If I didn't ask for help, I wouldn't have got out of the situation. I had to ask for help. I had to swallow my pride, put on my big boy pants, and ask for help. So whether you're here just gain clarity, and what they're saying and all this nonsense. I'm worried about what the data says. So I'm going to share my screen with you guys now so we can start talking. So the first thing that I wanted to share was this ridiculous post. And when I first read it, I even got sucked into it. I was like, "Oh my gosh. If I'm getting sucked into it, like what is actually happening?" It must be doing its job. So I want to get into this. So, no, homeowner delinquency rates are not elevated like you may be thinking if you're paying attention to these influencers and these crash bros, right? There's a few of them. There's probably a lot more than I even know, but there's a good amount of people who are always, saying, "Oh, this and this is happening, and this is happening." And to be honest with you, it's actually ridiculous. Actually, I want to share the right thing with you. I don't want you guys have to see all this crap. This is how you know it's live, and I'm not AI. I've gotten asked that before. Is this an AI or is it actually live? All right. Looks like it froze up on me. Well, that's not good. It froze up. But anyway, if you can still hear me, my screen is actually frozen, but I'm going to keep rolling with it until it unfreezes because I know eventually it will. But here's the thing. There was a bigger creator, Patrick Beck David, and he shared this graph. And in the post, right, because he shared it on X and Facebook, and he said 6.1 million people are behind on their mortgage. 6.1 million people are behind on their mortgage. And if you read that, at first you're thinking to yourself, oh my God, that's insane. How are this many people behind? How is that possible? Because that's like a lot of people, right? So I read that and I was like, there has to be more to this story. There's no possible way that 6.1 million people could be behind. So here's the thing. He showed a screenshot of the graph, and I guess his team, they missed it, right? Because they just put it up. And on that graph, it said multifamily. Multifamily. Okay. Multifamily, 5+ units. 5+ units. That's what he was talking about in that graph. But he portrayed it as it was single family homes. There's a huge difference between single family homes and multifamily homes. I mean, an enormous difference, okay? You can't get these things wrapped up. You cannot, right? So there's been so much backlash, and I actually think oh, look, we're back. I can see my screen again. He's had so much backlash from it. And honestly, I'm like, how did you share that, dude? Like, how do you not do that? Because homeowner delinquency rates are not elevated. And so many people have come out after that and said, hey, this is why. Homeowner delinquency rates are rising from record low levels, but aren't back to pre-COVID-19 levels yet. And this is what this creator is saying, right? Over the weekend, there was a lot of discussion on social media around homeowner delinquency rates. The situation prompted him to write this article. Look, here it is. Here's what he shared. And I know it's hard to see because it's even hard to see on my screen. But it says Freddie Mac serious delinquency rates multifamily. Right there. Multifamily. Okay? Not single family. We're talking 5+ units. And honestly, like this is an issue. I'm not saying that this is not an issue at all. But if you're following these creators, right? These influencers, Patrick Bet David has audiences of like 10 plus million across all platforms. So this is very misleading the way that it was labeled. And then when homeowners see that, they automatically think, what is going on? The market is crashing, right? There's so many people out there that are always putting that information. I don't even know. I can't even call it information anymore. I don't know what the heck it is. It's just garbage, right? Because they know they're preying on the vulnerability of what people like you and me, homeowners or want to be homeowners that are in the market to buy. They're preying on the fact that like, oh, they're probably not going to dig too much into it. They're not going to worry about it too much. They're just going to listen to what I have to say. And then once they listen to what I have to say, they're going to believe it, right? So they've been calling for these crashes. They have been calling for them for years. And I'm not trying to say that it's not possible. You can never fully rule out that it's not a possibility. But here's the deal. He's in this article, the discussion began with the social media post, which we just talked about, leading many to believe homeowners are under significant stress. That's not the truth. The data referenced Freddie Mac's seriously delinquent levels on multi-family homes, multi-family mortgages, which are used for commercial properties with 5 or more units, such as apartment buildings. As always, you have to examine the data closely. And again, this is a serious issue. I mean, the fact that there are, I call them mom and pop investors. People have smaller units. These aren't institutional investors, right? Like the BlackRocks out there and these big hedge funds that are buying up. These are small multifamily people, people that just want to get ahead in life and build a nest egg. And they do that through investing in real estate, which there's absolutely nothing wrong with. There's nothing wrong. I love investing in real estate. Sometimes it drives me nuts. But for data on homeowners and their delinquency rates, let's look at the most recent data from ICE, not to be confused with the ICE that you keep seeing in the news and deportations and stuff. And I have another full article on this that I wanted to share because I think it's actually better than what this gentleman was talking about. But here's the deal. Regardless, you have to look into the right information. If you're not looking at the right information, you're going to struggle to understand what is actually going on. You have to fact check it, right? And I could be wrong, right? But I try and find the actual data that makes sense. So ICE's February 25 report reveals a concerning trend in delinquency rates, okay? It is a little bit concerning. The national delinquency rate increased to 3.53%. Okay, that seems like a high number. It's up 5 basis points month over month and 19 basis points year over year. Here is the major issue that we're facing. FHA mortgages represented 90% of the 131,000 year over year increase in delinquencies, despite comprising less than 15% of active mortgages. So when you're hearing this information, if you're getting a snippet of it from TikTok or from the news or from YouTube or from wherever, you're thinking to yourself, wow, it increased 3.53%, but it's only up 5 basis points year over year or month over month, and then 19 basis points year over year. And then you see, oh my God, FHA mortgages makes up 131,000 of the year over year increase. The most important thing that you can take away from this, FHA loans comprise of less than 15% of active mortgages. Less than 15% of active mortgages. That means 85 plus are not FHA loans. They're either US, the bulk of them are conventional. The bulk of them are conventional, like I have a conventional loan. And I believe a huge reason for these more and more FHA loans to be facing delinquencies right now is because generally, I would say, I don't know, 90% or more of people who utilize an FHA loan are first-time homebuyers. And first-time homebuyers aren't the strongest purchasers of properties. They're not. They generally are the ones who have lower income, but they can still qualify for a loan and then they can purchase a home, but they're strapped more for cash because they're first-time homebuyers. There's nothing wrong with that. I was there. There's nothing wrong with it at all. But this is the reality. These first-time homebuyers who were buying, mind you, in 23 and 24, and even at the beginning of this year, they're buying at such elevated price points. Homeowners insurance is so expensive. The cost of repairs is so expensive. Interest rates, mortgage interest rates are so expensive, right? So everything is so much more expensive for them. Of course, they're going to be the ones that are facing these issues of falling delinquent because they can't keep up. They cannot keep up. Notable impacts include 4,100 homeowners in LA falling past due to wildfires, up significantly from 700 in January. While foreclosures start negative 17% and sales negative 11% decrease in February, they showed year-over-year increases of 34% and 7% respectively, particularly affected by resumed VA foreclosure activity. So that's very interesting as well. There was another article that I came across that I thought was, yes, this was going to be perfect to share. It's actually a Substack, right? And this really details everything that you could want to understand about single family serious delinquency rates, which increased again, but you have to pay attention. Increased from what? Increased from where? Right? Because the benchmark now is we look at pre-pandemic levels. That's like the benchmark. We have post-pandemic levels and then pre-pandemic levels for pretty much everything when it comes to housing. The cost of housing, the price of housing, interest rates, delinquencies, foreclosures, everything now is based off of pre-pandemic and post-pandemic. That's how it's going to be moving forward. Fannie and Freddie's single-family serious delinquency rates increased in January. Oh my gosh. But pay attention to what he says. Freddie Mac reported that single-family serious delinquency rates in January was up 0.59%. Not even a full percent. Okay? Freddie's rates is up year over year from 0.55% in January of 24. However, this is close to the pre-pandemic level of 0.6. And then in addition to comparing it to pre-pandemic levels and post-pandemic levels, well, the benchmark, before all this, in 2020 and before, was comparing it to the 2008 crisis, right? Because you really, in order to really understand if we are in a very bad situation or not, you have to also compare it to the 2028 crash, right? And this graph, we'll get into it. It's going to do that. Some of the recent increases in the 90-plus day delinquency rate is probably related to the hurricanes last year. Places like Asheville and Tennessee and all that area and Florida, right? All these places that got crushed by the hurricanes last year. This is serious, right? And he's saying that he's saying probably related. It's probably very, very likely it's related to that. In addition to everything being so much more expensive now. Freddie's serious delinquency rate peaked in February of 2010 at 4.2% following the housing bubble and peaked at 3.17% in August 2020 during the pandemic. Okay, so those are two very important benchmarks to understand. February of 2010 And then August of 2020, Fannie Mae reported that the single family serious delinquency rates in January was 0.57, which is up from 0.56 in December. So, not that significant of an increase at all, but it is an increase. The serious delinquency rate, so serious is 90-day plus, is up year over year from 0.54. However, this is below pre-pandemic lows of 0.65. All right. There you have it. So let's look at this chart because this really details where we're at right now. As you can see, again, remember the benchmarks are comparing 2008 levels, 2009, 2010, and then pandemic levels, pre-pandemic. So you can see here that in 2010, so January of 2010, Fannie Mae and Freddie Mac were significant. Okay. These levels of serious delinquency. Oh, God, why is that so hard to say? Serious delinquency. If you can say serious delinquency 5 times in a row really fast, you're special. Anyway, this is 2010 right here. Okay. This is when it was the highest that it's been since at least this chart goes back to 1998. And then you can see everything dropped. So the housing crash of 2008 that lasted, until 2010 and 11. I listened to an amazing podcast about that. And the way the host described it was that it was more systemic. That was the word he used than what we're experiencing right now. So what he meant by that, and he was describing how it was systemic, is there were thousands and tens of thousands of people who borrowed these subprime loans and these no doc loans. They called them ninja loans, no income, no jobs, no assets, right? You didn't have to report anything. And banks were giving you money, and these people had multiple homes, 120% financed, 115% financed, over 100%. So many of these people, the subprime loan market is what created this crash, right? And that was systemic. This was years leading up to than what we're experiencing right now, right? And as you can see, as the years went on, it went down significantly. And then here we go, pandemic, boom, it shot up. And now it has gone down significantly. Yes, it is still on the rise. It's rising a little bit, okay? Not saying, and I'm not trying to say that this isn't an issue, but as you can see, if you go back to 1998, you can see that these levels that we're at now are still very low. People are shouting out at the rooftops that we're in this huge financial crisis, right? And I get it. We're still printing money like crazy, and interest rates are stinking high. The cost of everything is really high right now. And there will be a fallout from that eventually, right? But you can't say definitively that we're going to have this 2008 style crash like all these crash bros always talk about. And they've been saying it for 5, 6, 7 years, right? They always say the same thing. Eventually, they might be right, but you really have to look at what the data is actually saying. So these are mortgage loans that are three monthly payments or more past due. That's serious delinquency. That's what I said, 90 days past due. Mortgages and forbearance are being counted as delinquent in this monthly report, but are not reported to the credit bureaus. For Fannie, by vintage, for loans made in 2004 or earlier, which is 1% of their portfolio, 1.46% are seriously delinquent, down from 1.47%. That's interesting. For loans made in 2005 through 2008, 1% of their portfolio, which is not that many, 2.08% are seriously delinquent. Wow. For recent loans originated in 2020 or 2009 through 2000 or 20, why can't I say that? 2023, 98%. So Fannie Mae, 98% of their portfolio is from 2009 until 2023. That's staggering. 0.52% are seriously delinquent, which is up from 0.51, less than 0.5% is delinquent. So, what this is saying is, in essence, we are not in this kind of ridiculous situation where a lot of these people portray it to be. Okay. We're not facing some kind of major crash that is incoming. You and this is the most frustrating thing about it is people are really, really, really leaning into the fact that we are in some kind of major economic downturn where all these people are going to start going seriously delinquent on their mortgages. And people are not paying attention. We're not paying attention to where we need to be. We're not educating ourselves honestly. We just take these headlines, we take this fancy YouTube titles and their thumbnails, and we're like, "Oh my god." We form opinions immediately, and then we think to ourselves, this is going to be really bad. Here we go. This is where everyone's talking about the crash, right? The crash that has it should have happened, 5 years ago based on all this. And that's not the truth, okay? So this is what the data is actually showing us. I have one more I want to share with you guys because it's very important. FHA and VA versus conventional loans. So, according to Washoe, the labor market remains relatively strong and often tracks with mortgage performance. Some of today's headwinds include inflationary pressures, low personal savings rates, natural disasters. Of course, we talked about that. Increasing consumer debt, that's going up like crazy. Consumer debt is absolutely going up like crazy. Higher taxes, yep, and insurance payments, and higher debt to income ratios. All of these factors may be impacting government borrowers to a greater extent than conventional borrowers. Okay. So you can see here the FHA and the VA delinquency rates, it is still fairly low. It's fairly low, right? And it is starting to increase more. And I would probably expect it to go higher as time goes on with all the uncertainties that are taking place with the tariffs. Today's Liberation Day, right? The words that and the names for all this stuff is so funny. We'll see if it stands to be an actual Liberation Day. Hey, I could look back in 2 years at this video and I'll be like, yeah, there we go. It is Liberation Day. But another article that I was reading, it made a really, really, really good point. It's 40% of people who own homes. For There's 98 million the last time I looked, around 98 million homeowners, owner occupants in America. People like me, like you. I'm in my home right now. I own it. We live here. It's not a vacation home. There's about 90 million. 40% of those have no mortgages. None. They are owned free and clear. So they pay taxes and insurance and maintenance, right? They don't pay any mortgage. Of the 60% that remain, a large portion of them have low interest rates because they purchased, from 2022 before and sooner. Like me, I bought at 2.625 in 2018. Right? So we have very, very low rates, and those aren't the delinquent ones. It's the majority of delinquencies that we're seeing. The majority of delinquencies that we are seeing comes from people who have bought more recently. Again, for the reasons that I already talked about. It is staggering how expensive everything is now. And people are we're paying more for goods and services, and we're not making more money, right? We're not making more money, but we're paying more money. The majority of Americans are not making more money than they were last year or the year before. And if they are, it's very insignificant. The majority of people, right? Of course, there's always going to be the top 1% or even the top 1 to 5%, but the 95, the rest of the additional 95%, they're not making more money, but we're paying more. And especially with the tariffs hitting now, we're going to be paying even more than that. And this is going to put a huge pressure on homeowners, right? And these people like you and I who have mortgages, who might be facing these issues where we have to essentially pay more money, but we're not making more money. And this is also some good information about it. By loan type, the total delinquency rate of conventional loans decreased by 1 basis point. The FHA delinquency increased by 57 basis points, and VA delinquency rate increased as well. So conventional went down, VA and FHA. Again, the VA and FHA buyers, they put down smaller down payments generally because they don't have enough, right? So they are lower income people who are buying homes. So they are going to be the ones that are in a delinquency. They're going to be more affected by it. And they're going to be the ones that go into, hopefully not foreclosures, but forbearances and loan modifications. I'm going to get into all that later. I'm going to show you what you can do if you are going through that. And I'm going to touch on that in a little bit. So on a year-over-year basis, total mortgage delinquencies increased for all loans outstanding. The delinquency rate increased 1 basis point. The delinquency rates include loans that are at least one payment past due, but this does not include loans in the process of foreclosure. Okay. Non-seasonally adjusted. Yes. So all this is good. Now, I don't want to keep blabbing about delinquencies and what is happening, right? Because you have a good idea. If you watch this, you have a really good idea of what is happening. Okay. What I want to share with you, and a huge goal of mine with this channel, is always to provide great information to homeowners, all about the home ownership process, right? All about the home ownership process, making it more accessible and making it more, it's at times like it feels so stressful to own a home, and nobody talks about it. Nobody talks about it. I've tried to find so many different creators or channels that really talk about it at a high level of what it's actually like to own a home, because for people that are in my industry, right? For other real estate agents and real estate brokers, here's what it's like. Here's a glimpse into what it's like. All they focus on is helping people buy and sell. Now, I'm not trying to say that in a degrading way, because it is their business, right? It is the business of real estate agents. Okay? Real estate agents help people buy and sell homes. It's a noble business. I've done it for years. But what I've come to realize is it is very transactional. It's one and done. And then you move on to the next. Okay? One and done, and then you move on to the next. Sorry. I see it's like cutting in and out. I don't want it to be too distracting, so I'm trying to get my mic out of the picture. But it becomes one and done. It becomes very transactional, right? And people buy and sell a home a few times in their life. That's it. I bought two homes now, right? I would say I'm a little bit different, but because I'm always trying to buy investment properties. But it's very transactional, right? But what I've realized is that owning a home, you do it for a long time. You own a property for a long time. And rarely, and now there definitely are, but I'm not coming across anyone that actually talks about what it's like to own your home, right? All the stuff that goes into it, the maintenance of it, the dealing with insurance, the dealing with repairs and trying to navigate everything about what it's like to be a homeowners, right? So that is like a huge, enormous goal for me and for this channel is to share what it's like. And unfortunately, we come into issues with this. And you can be put in a position where you might have to, unfortunately, it's very unfortunate, but here's the deal. You might come into an issue where you have to figure out how to modify your loan. Okay. So, what do you do if you're falling behind? Or if you're just like freaked out? You feel like it's going to happen at some point because of various different reasons, things that we can and things that we can't control. And in my experience, it always comes down to things that we cannot control, right? We have a certain level of control over our finances and how we spend and how we save and how we invest. But there's always outside circumstances that come into play that affect our income. So, what do you do if you are falling behind? What do you do? A lot of people are fearful of admitting it. Again, this is what I touched on earlier. We have this sense of pride that we don't want to seem vulnerable. We don't want to feel like a failure. There are all the feelings that I felt going through this, and this first step in this process is you have to talk to your lender. You have to talk to your lender before you're going to miss the payment because you have a great understanding, I hope, of your finances and whether you can make your mortgage payment or whether you can't. So, the most important thing that you can do is talk to your lender before you're going to miss a payment. Do not wait until things get out of control, until they snowball, right? You have that small snowball issue. It's in your hand. Do not stand on top of the hill and let it roll out of your hand and become unmanageable. Because once it becomes unmanageable, it's very difficult to come back from that. Early action means you will have more options. Your lender, for the most part, they want to work with you. They want to make sure that you can pay because it makes them money. It makes sense for them to work with you. And they want to keep your loan. They don't want you to go into foreclosure. That means they don't get paid. They have to wait for your payment. They don't want you to sell the property because they want you to pay monthly. They make money off the interest that they charge you. So you have to take action early. And I know it's scary. And I know you have a tremendous amount of pride. And I know you don't want to, again, feel vulnerable. Nobody wants to feel vulnerable. But I promise you, if you take early action, if you do this up front, you're going to have more options available to you. The last thing that you want to do is wait until the very end before, you don't want to be 90 days late, 120 days late before you're finally contacting them, right? Because they're already taking foreclosure action by then. And it's depressing. And you're going to get into a mindset of how did I let this happen? How did I fail myself? How did I fail my family? How did I fail? What did I do wrong? So if you take early action, you're going to be putting yourself in a better position. Next, you have to understand what your programs are. And I'm not going to get too in depth into this because if you want more information about what to do, I can share with you uh, a much larger document that I created that's all about, what to do if you're feeling that stress and if you're feeling behind, you're going to miss your loan, okay? But you have to know your programs. You have forbearance where you don't pay for a certain period of time. It happens a lot with student loans. That's something that I don't have experience with. The loan modification is what I do have experience with. This is what I had to do for the home that I live in. We had to have a loan modification done, right? And then there's other repayment plans too. These tools, they exist for a reason. You may think that your lenders don't really care about you because they're these giant corporations, they're these giant organizations. And, maybe the CEOs don't, or the vice presidents, they don't care about us little guys, but there's always somebody there who cares, right? And over this process, I talked to multiple different people, and a lot of them approached it from an empathetic standpoint. Like, hey, we want to help you. We know what you're going through. We want to help you. And there are tools that are available. There are actual tools, especially through the government-backed programs. So the FHA loans, the VA loans, the USDA loans. Here is the critical part of this. You will not know what's available to you unless you ask, unless you can actually put your pride to the side for the time being and ask for help. You're not going to know what your programs are. But that's the second step. Number 3 is get free help because there is no shame in this. There is no shame. Again, we're going through very difficult seasons. It's just a season of life. There's absolutely no shame. Who cares what anyone else thinks? If you care what anyone else thinks, don't tell them. You don't have to necessarily tell your friends and family you're going through this. You can reach out to help. HUD approved housing counselors are available. They're trained to help and they're not going to judge you. You can talk about this to someone for free. Where again, they're not going to have any judgment towards you because they do this all the time. They help people out through this all of the time. They've seen it all. They know what to do. They know how to approach it. They know how to talk to you. They know what you're going through. You have to find help. I don't care, again, how prideful you are. If you're going through this, don't let it go too long before asking for help. Look, when we were going through the process, I got letters all of the time about free help, all of the time, all kinds of different programs. There's people out there that their job is to help guide you to making smarter financial decisions. They're paid from the company, right? They're however they're paid from their company, it is how it is, but they offer it to you for free. That's amazing that there's people out there who do that. And again, there's no shame involved. And the last step is this is probably the most important. And this is a step you can take right now. You have to audit your life, not just your budget. Think about what you're actually spending your money on. Think about it. If you're listening to this and it's in your head right now, that's great. Just think about how you're actually spending your money. You have to start reworking your plan. And for a lot of people, you don't even have a plan. You don't even have a budget. I mean, the budget is like the first step. Just have a simple budget that you can follow. I had to sit down at the beginning of this year and put my budget in. I have this app, Monarch. I can share that in the description. Tracks all of my finances. My bank account is linked to it. So everything that we pay out of it and everything that comes in, it's tracked. Once you track it, then you can see where you're spending too much money. That is the only way you can figure out where to cut back. Once you understand how much you're actually spending and on what, because so many people, we just have everything on autopay. Life is on autopay right now. and you don't know what subscriptions you're subscribed to, you don't know even how much debt you have. You don't understand where your money is going until you can actually track it. And I love this aspect of it is define what peace looks like right now. Like what would that mean for you if you were all caught up? What does that mean for you? You're caught up on your uh, at least you know. Like how peaceful would your life be if you just knew where your money was going? If that's it. You just knew where it was going, right? That's always the first step is understanding what you're spending on. And then look at what does stability look like for you in this season. I'm not saying if you're in $50,000 of credit card that you have to pay it off tomorrow, and if you are in that significant of debt with your credit card, reach out to your credit card company. See what they offer for people that are in this season of life. It's not just a mortgage, right? You can reach out to your car loan. If your car loan is getting crazy and you can't cover that, right? You have to understand that in order to get help, you just need to ask for it. In order to get help, you need to ask for it. And I don't care when anyone's thinking, I don't care. You don't have to keep up with the Joneses anymore. This isn't a thing that you need to do. Focus on what you can control. Tracking your expenses, especially when it comes to what you're paying on a monthly basis, is very important. Get everything under control. Your mortgage is always going to be one of the most expensive things that you ever have to pay on a monthly basis. I can't think of anything more expensive. I mean, childcare. That's a whole different story. But your mortgage, you're going to be paying significant amounts of money out of your income towards your house. And especially people who bought in the past couple of years, it's even more significant than it is for someone like me who bought in 2018. So it's very expensive. You need to just make sure that you can cut out the pride and figure out what the next steps are. So moving forward, let me know after you watch this what kind of content would be more valuable to you. Because I make content all the time about selling your home and upgrades and things, but I want to go deeper than that. I want to go a lot deeper than that to figure out what is actually going to be more valuable to you on a day-to-day basis. Again, because you may have been in your home for 10 years and you're not going to sell for another 20 years. But there's things that happen along the way. Repairs, DIY stuff, I'm going to try and share it all with you. As I learn, I'm going to share with you. So let me know what is more valuable. What is going to be valuable to you when it pertains to the home ownership process. Thank you so much for tuning in. If you have any questions, just drop them into the chat. Have a great day. See you next week.